Please do.
With your permission. Thank you, sir.
Dear Jayantins, I would like to bring to your notice a few general instructions. Please keep your microphones on mute. Kindly maintain silence throughout the session. And finally, students, maintain the Jayantin decorum. I quote, wisdom is not the product of schooling, but a lifelong attempt to acquire it. Albert Einstein. A very warm good evening to one and all present here. The most estimable resource person, Dr. Manoranjan Sharma, Dr. K. Vinoda Devi, Head of the Department of Economics, the faculty members, and my dear Jayanti. Welcoming each and every one of you to the second session of the budget lecture series in Union Budget, Reading Between the Lines. Prayer is not asking, but rather the longing of soul to align our hearts to the divine. I request all of you to close your eyes and bow your heads for a few seconds of silence. Thank you, everyone. The primary goal of the Union Budget is to promote social justice and equality while encouraging quick and balanced economic growth in our nation. For the past few days, as a part of the budget week, we as economics students of Christo Jayanti College has been provided with a privileged platform for the exchange of ideas and various perspectives regarding the Union Budget that was proposed as of 2nd February 2023. On this pleasant day, I deem it a privilege to offer a hospitable welcome to the auspicious gathering through the Zoom platform. It's my pleasure to welcome the honorable guest, Dr. Manoranjan Sharma, Chief Economist of Informatics Rating Delhi and the former Chief Economist of Canara Bank. It's indeed my privilege to welcome you on the behalf of the Department of Economics, Christo Jayanti College. Good leaders are the ones that bring enthusiasm, happiness, energy, and encourages others to move ahead. I take this opportunity to welcome one such leader among us, Dr. K. Vinoda Devi, Head of the Department of Economics. She has always been our guiding light to knowledge and success. It's my privilege and honor to welcome you, ma'am. I extend a cheerful welcome to the faculty members of the Department of Economics and all my dear Jayantis. Once again, I welcome you all. Now it's time to introduce our estimable resource person. I would like to invite Ms. Kirtanavi to do the profile.
Extremely delighted to honor the resource person for the day, Dr. Manoranjan Sharma. Dr. Manoranjan is currently working as the Chief Economist, Informatics Valuation and Rating Private Limited, Delhi. Sir has MA in Economics, postgraduate diploma in Business Management, and was awarded PhD with doctoral dissertation in Banking, MSMEs by the University of Lucknow in 2010. Dr. Manoranjan worked as the Chief Economist of Canara Bank, Assistant General Manager of Small Industries Development Bank of India, Manager of NABARD, and so on. Sir published over 300 papers in a period of 40 years, including in the Business Review, Cambridge, occasional papers, RBI Mumbai, Journal of International Research Publications, Economy and Business, Bulgaria, the Indian Banker, IBM Mumbai. Dr. Manoranjan also worked as resource person for FICCI, CII, and Ministry of Human Resource Development, Government of India. Sir is the member of Advisory Board, AGISS Research Institute, Noida, member of Reviewer Board, Journal of Emerging Technologies and Innovation Research, Ahmedabad, member, GLG Council of Policy and Economics, Washington, D.C., USA. It's truly an honor for us to hear from such a reputed personality like you, sir. I once again welcome you and invite you for the talk. Over to you, sir.
Thank you. Am I audible?
Yes, sir.
Oh, thank you very much. Thank you, Dr. Vinoda Kumar, distinguished faculty members, teachers, students, friends, ladies and gentlemen. I am particularly thankful to Christianity College for having me with you for discussion on this important subject. Now, my basic take on the union budget is that it will attempt to drive economic growth with fiscal prudence. Historically, if you look at things in a proper historical and comparative perspective, what we find is that Cautil's Arthashastra several centuries ago first mentioned the basic tenets of a budget, and he brought to the fore the concepts of revenues, expenditures, and fiscal deficit. Post-independence, under Article 112 of the Indian Constitution, a budget is required to be placed on the floors of Parliament. So in this sense, sometimes the budget is taken to be a mere accounting statement. But my submission would be that the budget also provides an indication of the state of the economy, priorities of the government, and the use of instruments to realize identified objectives, influence, direction, and pace of the economy. Hence, the budget is much more than a public statement of expected government revenues and scheme expenditures over the period of a 1 year. With this kind of a perspective, let me attempt to stress that the budget should not be seen in some kind of a silo in isolation, because it's a microcosm, it's a miniature model of the broader Indian economy. As all of us are aware, these are difficult times, these are times of turbulence, times of great challenge. All of us would recall the horrifying days of March, April 2020, 2021, when we passed through the difficult phases of the pandemic. This COVID-19 pandemic was sometimes compared to the Spanish flu of 1919. So in that sense, it was the most severe economic and medical emergency to hit the global economy in the last century, 1909. So after about a century or so, it hit the world. In economic terms, the COVID-19 has sometimes also been compared to the global financial crisis of October 2008 and even the Great Depression of 1929. But the data and the analysis which came into public domain, whether you look at authoritative studies of the IMF, the World Bank, OECD, Organization for Economic Cooperation and Development, ADB, Niti Aayog, and the Reserve Bank of India, all of them, they substantiate the thesis that this was a crisis of greater dimensions, far-reaching magnitude, far-reaching ramifications and repercussions than the global financial crisis of October 2008 or even the Great Depression of 1929. In this overarching setting, disequilibrium became the new equilibrium, and therefore this budget provides the roadmap ahead in the new normal. Now, if you look at the evolving data points in the Indian economy, what you find here is the worst is clearly behind us post the COVID-19 pandemic, and India is on a high growth trajectory. However, the heightened geopolitical dynamics in the wake of the Russia-Ukraine war, the high fuel prices, volatility in the price of oil, high logistics and interest cost, volatile capital flows, and exchange rate volatility, the scramble for safe haven and the attendant correction in asset prices cause concern. At the domestic level, if you look at the Indian position, there are concerns of high inflation, unsustainably high fiscal deficit, high unemployment rate, and the risk of a recession in several countries. Now, India has emerged as a bright spot in the global economy. India's growth is here to stay. India will be the fastest growing economy in G20 in FY23 after Saudi Arabia. This is a basic finding of OECD. I would like to draw here attention to one important data point, and that is India is expected to remain a growth outperformer in the medium term with an average GDP growth of 6.6% between fiscal years 2024 and 2026, uh, as against 3.1% likely to be achieved globally. And this is a very significant finding of the International Monetary Fund. So it has a lot of credibility and authenticity about it. India is expected to drive global growth with doubling of its GDP from $3.4 trillion now to over 8.5 trillion over the next decade, with a thrust on investment, exports, and employment, GST, corporate tax cuts, PLIs, and the larger formal economy. Now, India would grow briskly because of macroeconomic stability, despite monetary tightening, which could reduce stock prices, weaker currencies, and higher bond yields, enhancing government's borrowing cost. According to the economic survey, the growth rate may slow down slightly to 6.8% in FY24. That means for the year ending March 24, as India's exports have been hit by the current global challenges. Despite this sort of a headwind, Indian economy will continue to be the fastest growing major economy in the world, but there are certainly concerns of monetary tightening, the global slowdown, and decelerating manufacturing. Now, this is the broader picture, but as we say in English language, to banking, finance, so many other things, sometimes the devil lies in the detail. So this is the broader picture, but let me also attempt to highlight um, some risk factors, some areas of concern. One, I would like to do, first, let me draw attention to this, some kind of a sectoral skew, sectoral unevenness, asymmetry in India's growth process. Uh, if we look at the manufacturing and the services sector this year, you'll find that the growth has been led by BFSI, banking, financial services and insurance, automobiles, and telecoms. And there are some sectors of the economy, such as metals, oil and gas, and select consumer durables, which have not performed all that well. Sorry. Second issue to which I would also like to draw attention is that while it is true that the global economy is growing at something like 2%, the Indian economy could grow by 6%, thereabouts, or even more. But when you do some kind of a disaggregated examination, when you make a granular examination of data, what you find is that there are several other benchmarks, several other leading indicators which are looked at closely all over the world. One such indicator is the per capita income. So when you look, now all of us have rejoiced over the fact, have been very happy that India, I think about 4 months back, we became the fifth largest economy globally all over the world, displacing United Kingdom, which is now the sixth largest economy. So now all this is very welcome and certainly commendable, and we can justifiably take a sense of pride in this. But when you do a disaggregated examination, what you find is that we have certainly displaced United Kingdom to the sixth position. We are now at the fifth slot. But when you look at things in per capita income, our per capita income is still something like $1,500 per capita. Whereas in case of UK, it is something like $4,400 per capita. So if you look at things in a per capita income, we have still a lot of catching up to do with the best in the world, even with the third, fourth world countries. However, there are some strong factors which are expected to drive India's growth going ahead. These relate to persisting demographic dividend. If you look at India's demography, what you find is about 50% of the population today is less than the age of 35. Uh, Services export opportunities, domestic demand potential, rising middle class, and India's emergence as an attractive investment destination. There has also been a welcome thrust on infrastructure in the last few years. So this is again a very welcome development in the sense that all over the world, infrastructure has emerged as a catalyst to development. Now, coming to this year's budget, the budget shows that the Indian economy has demonstrated resilience against the concerns of globally synchronized slowdown, unemployment, inflation, and the deferred shocks of the pandemic. Against this kind of a backdrop, this budget for this year, 24, focuses on 7 priorities, and these priorities relate to inclusive development, reaching the last mile, agriculture and investment, unleashing potential, green growth, youth power, and the financial sector. Now, let me turn to some major issues of concern in this budget, in any budget for that matter. One, of course, which gets the maximum space, whether you look at the print media, electronic media, is the number relating to the fiscal calculus, the fiscal deficit. A fiscal deficit is very important. I am reminded of a powerful quote of Dr. Shankar Acharya, who was India's former finance secretary. Later, I think he was a eminent professor at NUS, National University of Singapore also. So Dr. Acharya wrote, I think sometime about 15 years ago, and a quote that high fiscal deficits tend to crowd out public-private investment, increase inflationary potential, weaken the balance of payments, render financial sector reforms more difficult, and impose a serious burden on future generations. So this is what Dr. Shankar Narayan identified the impact of fiscal deficit to be. So this still continues to be so. So the fiscal deficit numbers have to be carefully considered. I would also like to take you a little back that this has been a long-standing concern. Some of you may be aware that in 2003, a former finance secretary, Mr. N.K. Singh, who was the part of the team to start economic reforms in India way back in 19, but Prime Minister Narasimha, that time it was Manmohan Singh, and Mr. N.K. Singh, the finance minister, is an exceptionally well-bred, qualified, and a competent person. So he was the brain behind formulating this FRBM Act, Fiscal Responsibility and Budget Management Act, which was enunciated, which was formulated for the first time in 2003, and they formulated a glide path for the fiscal deficit to reduce gradually. So obviously, all of us are aware that the last 2-3 years have been difficult years, 2020 and 2021, and because of the pandemic, the concerns of fiscal deficit were largely given a go by. But now that things are recovering quickly, we must be focused on the concerns of a prudent and judicial fiscal policy. Now, when you look at the aspect of fiscal policy this year, we find that thanks to robust tax collections, last year the government contained the fiscal deficit at the projected level of 6.4%. The FM has projected that next year the fiscal deficit could be 5.9%, and in FY26 it could fall further to FY26. Now here I would like to highlight some other areas which, because why this fiscal deficit number has been appreciated both in India and abroad. One is, I do not wish to make any political points, but still, when the last government was in power, some of you may be able to recall that the government had postponed several expenditures in the budget. They had resorted to what is technically called off-budget items. Huge oil bonds were shifted to future generations were forced to pay off these oil bonds. So there is no such hidden item in the budget now. So this adds greater transparency, greater credibility to the budget numbers. Now, how do we finance these fiscal deficit? Obviously, some standard measures are taxation, public borrowing, to a certain extent, deficit financing, and disinvestment. So let me try to take up each one of them. when you look at the tax collection, this year's tax collection, this year, I mean the current year, which is in force, which will end on March 31 this year, uh, the government had projected tax collection of something of the order, total tax collection of direct and indirect taxes taken together was 27.5 lakh crore. But it is likely that we may end with a total tax collection of 31.5, 32 lakh crore, which is well above the budgeted estimates. So why do we say that? First is that the direct, basically the tax is two components, as all of you would be aware, direct taxes and indirect taxes. So when you look at the direct taxes, they were estimated at, for the full year, last year FM had estimated that this year direct tax collection be 12.5 lakh crore. But the latest figures which have come strongly suggest that direct tax collection would be something in the excess of 14 lakh crores. Now let us look at the indirect taxes. So when you look at the indirect taxes, for some months it was 12 months in a year, some months it was 1 lakh 60,000 crore, 1 lakh 70,000 crore, some months 1 lakh 30,000 crore. But consistently for the last 6 months or so, the indirect taxes, popularly called GST, also GST collections, have been something of the order of roughly about 1 lakh 50,000 crores a month. So when you multiply 1 lakh 50,000 crores over a period of 12 months, 1 lakh 50,000 crores into 12, that straight away comes to 18 lakh crores. So this gives us confidence that 18 lakhs of GST plus 14 lakhs, we will end up with, and this is expected to continue. This kind of a buoyancy. And what gives me greater confidence going ahead is that the FM in a tax collection for next year has projected an increase of about 10.5% in both direct taxes and indirect taxes. So some of the people have raised some doubts about the realizability of these figures, whether we'll be able to achieve to this kind of a 10-point growth in tax revenues. To my mind, this is a very realistic estimate, because here you have to realize that we are looking at these kind of numbers uh, based on nominal growth. So next year, India may grow at something like 6.5, 7%, something in the region of 6 to 7%. Okay, even if you take the median level, it will be 6.5%. Apart from this, next year we anticipate inflation to be in the range of something like 4.5 to 5%. So obviously, 6.5 plus 11 plus 5% to work out to 11.5%. So these will be reflected in the gross numbers of the taxation department. So obviously these are welcome. And now market borrowing this year is estimated at 15 lakh 43,000 crore rupees, and net borrowing is estimated at 11 lakh 81,000 crore. This year, the government is targeting an 11.4% growth in net tax revenue. Now, let me come to the issue of capital expenditure. One of the, again, very welcome aspects of this year's budget is that CapEx, capital expenditure, is slated to rise by 33%. So this is a very welcome thing. A lot of studies have been done in India, all over the world. And this CapEx works with a significant economic multiplier. Basically, as most of you be aware, the budget has two components, revenue and expenditure. Revenue means meeting the current needs. So when the government incurs some revenue expenditure, the usual multiplier which kicks in is something like 0.8, 0.9. So even if you spend 100 rupees on the ground, maybe it will have a multiplier effect of only 90. But when you spend 100 rupees on the ground in terms of capital expenditure, the usual multiplier for the first year is something in the region of 2.4 to 2.5, and 4 years down the line, it could even be 5x. That means in simple here, if you allocate 100 rupees to capital expenditure this year, maybe because of the multiplier effects, the beneficial effect would be something like 240 rupees, 250 rupees this year, and 5 year down the line, it could even be 500 rupees. So capex expenditure on investment, these are very welcome aspects. Here, I may briefly refer to the American experience. Some of you might have read that America was quite devastated by the Great Depression of 1929. Subsequent to the Great Depression, it grew at a fast rate. Now, a lot of studies have been made what facilitated America's faster growth. How did it realize its present position of preeminence? So while you could isolate and identify several factors, one of the most important factors responsible for the fast growth of the American economy has been the thrust on infrastructure. It is commonly said that America's ports, bridges, roads, airport built the American economy, and the American economy built ports, bridges. So in economics, finance, banking, we use an important concept of what is called a cause and effect relationship. So sometimes it is necessary to identify what is the cause and what led to the effect. But in case of the American economy, we find that there was a two-way causal relationship between American economic growth and the thrust on infrastructure. Higher infrastructure led to higher growth, and higher growth led to higher infrastructure. So this is certainly a good aspect. Another aspect which I'd like to draw attention to is that disinvestment figures are quite reasonable. The minister has factored in about 60,000 crore of disinvestment to kick in this year. Some of you may be aware that last year we had planned two big ticket investments. One was the privatization of Air India. The other was some kind of dilution of equity of the Life Insurance Corporation of India. While the Air India disinvestment process did actually occur, life insurance did not happen for various reasons. So I think this was the correct way to go about it, because the kind of pricing which the government was able to get last year was not the correct pricing. And this year, hopefully, if the stock market is congenial, conducive, the government could think of divesting. So why did I say that the government took a correct decision by going back on its intent to privatize, to dilute the LIC share? Because it's something like selling the family jewel. You may have inherited some gold, diamond jewelry from your parents. So even in case of an emergency, if you have to sell them off, don't sell them off at whatever price you are getting in the market. Wait for the right price. At least you should have some holding capacity, so that the market, gold market, bullion markets, stock market, they always keep going up and down. So when the price is right, you disinvest at the right price. So I think the government is conscious of these aspects, and this disinvestment will happen at the right time, at the right price. Now, there's also a welcome focus on MSMEs. There are large number of measures. It's not possible for me to go into all those measures, but I would like to highlight that these measures are very welcome, because if you look at the macroeconomic Indian position, you will find that 95% of all industrial units in the country belong to the MSME category. MSME accounts for 40% of exports, 40% of manufacturing. It is the largest source of employment in the country, next only to Indian agriculture. Those of you studying economics, maybe finance also, there's a concept called elasticity. So here, if you look at one of the major concerns of the Indian economy at the present juncture is the high unemployment position. So it has been demonstrated, not just in India, but all over the world, that MSMEs have high employment intensity. That means you get more bang for the buck. For the same kind of investment, you are able to provide employment. So large number of measures about presumptive maintenance of books of account, measures to support MSMEs in a timely receipt of payments. All these measures are quite well conceived. Now, let me come to the next aspect of infrastructure. As I said earlier, in capital expenditure has been increased by 33% to 10 lakh crore, which is more than double of 4.39 lakh crore last year to boost consumption and growth. If you look at economic growth, what you find is that capex or capital expenditure plays a crucial role by allowing a company to increase its production capacity, improve operational efficiency, and stay competitive in the industry. So, in this context, I would also like to highlight that it has been prominently mentioned in all the budget documents, also highlighted in Madam FM's speech, also, but that the capital outlay for railways has been increased to an all-time high of rupees 2,40,000 crore. So this will give a significant push to infrastructure and also to the process of growth and development. And because infrastructure creates huge jobs also, so we expect this would have a good impact also on the employability of the Indian economy. Now let me turn to another important aspect of the budget of the also of the Indian economy is the agriculture sector. Uh, Now, when you look at the position of agriculture in the Indian economy, you find an asymmetric process of development. Asymmetric also simply you could say uneven process of development. Now this is an important concept, so let me try to explain it. If we place things, Indian economic development in a proper historical and comparative perspective, what you find is that in 1950 or thereabouts, agriculture accounted for 50% of GDP. Now, prior to COVID-19, in 2020, this percentage had shrunk to about 14-15%. During the COVID last 2 years, because the manufacturing and the services sector took a huge hit, and by and large, agriculture displayed resilience. So there was some change in the relative shares of these three sectors: agriculture, industry, and services. Services is by far the most important sector of the Indian economy today, accounting for well over 60% of GDP. But the agriculture share has now risen to something like 19-20%. But still, uh, what I wish to highlight here is that despite accounting for only 20% of the GDP, national income, about still 56-58% of the people continue to be employed or maybe underemployed would be a better word in agriculture. So this throws an asymmetric process of economic development and requires sharper focus on raising the growth potential of Indian agriculture to raise production, productivity, and also to meet the concerns of distributive equity. So, to that extent, to raise the efficiency of Indian agriculture, productivity, production, there are very welcome measures such as setting up of digital public infrastructure for agriculture. This should be very useful in addressing farmer-centric solutions through relevant information services. And in this context, another welcome decision is to set up an agriculture accelerator fund to encourage agriculture startups by young entrepreneurs in rural areas. And now, sitting in Bangalore, most of you would be aware of the significance of startups. Bangalore, widely known as India's Silicon Valley. So when we extend this concept to startups to agriculture, obviously this is going to be good for the Indian economy. And the thing is, Bangalore, I think ragi and some millets are there. I was in Bangalore for several years, so unlike most parts of India, ragi and other things are commonly eaten. So here the thrust to millets cultivation is in terms of adaptability and maintaining nutritional level is also very good. Now, let me come to the banking sector, financial sector measures. The FM has proposed amendments to the Banking Regulation Act 1949 and the RBI Act 1934 to improve the functioning of banks. If you look at the position of banks in the last 2-3 years, I'm happy to share with you that there has been a remarkable improvement in the performance of banks, whether you look at uh, in terms of higher profits and profitability, net profits, or the level of NPAs. Yeah, some estimates, we are still to close this year, but there are some estimates which suggest that this year banks may have a total profits of about 1 lakh crore, which would be unprecedented and very welcome. I don't think banks ever recorded this kind of a humongous profit. And the related aspect is that there's been significant improvement in the level of NPAs, both in terms of gross NPAs and net NPAs. And if you look at the latest data for which figures are available for September 2022, this and GNPA's level, gross non-performing assets, had reached a 7-year low of 5% in September 2022. Going forward, it is expected that they could decline further by March 2023. One aspect of concern is that, or what you find in banks is that loans are growing very fast this year, something about 13-14%, but there has not been any commensurate growth in loans. So when you do some kind of a disaggregated examination for, I try to look at where is the loan growth coming from. So when you look at the asset side of the bank's loans and advances, what you find is, and this applies both to individual banks and to the banking industry at large, is that there are basically 4 components of the loan book in case of the commercial banking segment, which is obviously in banking the most important segment in commercial banking. These 4 segments are agriculture and allied activities, MSME, micro, small, medium enterprises, retail lending, and large corporate advances. So, because the possibility of loan going bad is much less in retail, so banks have obviously in the last few years focused on retail lending rather than so much corporate lending. Now, again, if you look at retail lending, this what we find is growing very fast. So there are some concerns of higher NPAs in retail. But basically, there are again 4 components of retail lending. These are housing loan, education loan, vehicle loan, and other personal loan. Because of the magnitude of huge funds required for housing, for example, in a city like Bangalore or Mumbai or even Delhi, if you want to take a flat, maybe even a 2 BHK, 3 BHK flat, I don't think in any decent area you may not be able to get it for less than 1 crore. So when you do some kind of a drill down analysis of retail loans, what you find is that housing loan account for something like 50% of the total retail portfolio, and by and large it is still considered to be a safe loan. But in other segments of retail loans such as education loan, vehicle loan, there have been some concerns of rising NPAs, so banks need to be a little cautious. Uh, Now, the energy sector is a very important sector for growth, structural transformation. But what is welcome is that this year, the FM has focused on green energy. Some of you may have heard these terms of sustainable development, climate change, environmental pollution, waste management. All these terms are related. And at the global level, the first time this concept came into prominence was at the level of UN, United Nations, way back in 1974, when the UN, United Nations, came up with a very powerful study called Club of Rome. I think it's easily available on the net. For those of you who may be interested, may go through it, Club of Rome. And this highlighted some of the areas of concern for us, for human beings to make some kind of a course correction. Subsequently, this was also followed up by the Brundtland Commission, which for the first time defined the concept of sustainable development sharply. By sustainable development means meeting the needs of the present generation in a manner which does not compromise the needs of the future generation. Obviously, in the last few years, there has been a sharper focus on other aspects such as climate change. Recently, I don't know if you have been reading the national newspapers, watching television. Uh, in Uttarakhand, earlier it was part of UP, close to Delhi, maybe about 300, 400 kilometers. So basically, it is a hilly region. We have a place called Joshimath. I Here it has been in all the news. So I don't know about Karnataka, but the entire city is sinking because of environmental concerns. So to that extent, the FM madam's focus on energy sector, particularly green energy, is very welcome and is certainly an idea whose time has come. So now, with this kind of a backdrop, let me come to my concluding observations. Given the devastating hit to the Indian economy by the COVID-19 pandemic and growth now gradually picking up, the accent has to be on increasing investment, creating externalities towards improving economic environment and enhancing productivity for sustained high growth. In the ultimate analysis, India's economy needs a sharper focus on all four engines of growth. Basically, if you look at the Indian economy, there are four basic engines of growth, which individually and together can drive the process of growth and structural transformation. These four growth engines are domestic consumption, government expenditure, private investment, and exports for sustained growth over the long haul. Uh, Now, taking an overall view, I would say that given the manifold global and domestic headwinds, the budget, which has been announced by the FM on 1st February, adopts a broad-based development strategy with a renewed thrust on economic development and inclusive development. But to my mind, there could have been a sharper focus on the health and education needs of the Indian economy. So I think with this, I will close and I will be happy to take field any questions, any queries which you may have. Thank you very much for having me with you here today. Thank you.
Yeah,
Thank
thank
you.
you, sir, for your knowledge enriching session on budget. There are questions, chat box.
Okay, so I'll help read out the question. The first one is asked by Tina. So this is it. So, what is your take on the strategic disinvestments being targeted since the Union Budget of 2020 onwards? Is it a good move or does it reflect the need to raise government revenue?
No, disinvestment is very good move, but disinvestment has been criticized in India consistently for that the targets set were very ambitious. You say, let us say in the budget document, you assume that 2 lakh crore will come from disinvestment. But at the end of the year, when you close your books, you find that instead of 2 lakh crore, only about 20,000 or 10,000 rupees. So this year's disinvestment figures are quite realistic and they have highlighted that from this investment, about 60,000 rupees could come. So, given the present state of the Indian economy, the focus, I think this could be very much realizable. These figures are achievable, and there is no element of overstating. I think this is a right move to mention a realistic, transparent, and credible figures. So, I think the figures are quite realistic. The figures are low. They have not mentioned a hugely impossible figure, something like 5 lakh crore or 6 lakh crore. They have mentioned the budget says 60,000 crore. So I think that given the present priorities and the working of the government of India across sectors, across geographies, this figure is quite realizable and hence it is a right kind of figure. Thank you.
Thank you, sir.
Uh,
Before I get to the next question, I would like to notify everybody to use the chat box for the queries while you guys remain unmuted. So, this question is very interesting. So, this is it. So, what's about less focus of social infrastructure?
Yes, I agree with you that maybe social sectors did not deserve the attention to they may possibly have deserved. But you must also look into the fact that the minister also had a compulsion to balance her books. Let us say maybe Dr. Vinoda is teaching in Christian. She has a salary of 2 lakh rupees. So she may want to buy a new vehicle, may want to buy a new house. So for that, EMIs will have to go. Then there are consumption expenditure every month, maybe school fees. So many maid has to be paid off. So at the end of the thing, economics or finance is all about uh, choices, about options. So had she overshot the budget and the fiscal, if you look at it is better to adopt a prudent policy. For example, if you look at the position in India's neighboring countries, I'd not like, you have asked an interesting question, otherwise I would have refrained from giving the example of, let us say, if you look at Pakistan, if you look at Sri Lanka, and now some scary news are also coming from Bangladesh in the last 2-3 years. So if you look at Pakistan, if you look at Sri Lanka, all these economies have completely collapsed. And why have they collapsed? There are several reasons for that. But had I some time, because that will take a full hour to explain. There are various factors, country-specific factors. But one thing which is common across countries, across geography, classic example at the world level is that of Venezuela. Uh, that concept of freebies, concept of uh, expenditure, incurring expenditure without raising adequate resources. So this element of playing to the gallery also is not proper. So obviously, social sector deserves some more attention. But given the constraints of a fiscal policy, the need to curtail fiscal deficit, the need to provide for infrastructure, capex, I think Madam FM's hands were quite tied. And given the difficult situation in which she found herself, I think she seems to have done the best of a difficult job. Obviously, if someone else would have been the finance minister, if you would have been the finance minister, maybe you'd have taken a different take. But then, on the whole, because of the need to curtail fiscal deficit, because the need to give a thrust to capex, infrastructure, and so many other things, I think she has taken the right call. Thank you.
Thank you, sir. The next question is, many developed countries, especially Scandinavian countries, has higher indirect taxes than direct taxes. This budget is gradually trying to move to this type of system. In India, which type of taxes should be dependent on more direct or indirect for revenues? Also taking into consideration its implication on production and commerce.
Well, two, three basic quick points. One is, if you look at India's tax to GDP ratio, it's very low, unusually low compared to any benchmark. Right now, if you look at India's tax to GDP ratio, it is something around 17%. So if you look at most countries, it's 25, 28, 30%. In most developed countries, it is in the band of 30 to 40%. Secondly, all over the world, including in India, if you, I don't know if your public finance has subject some basic books which have been there for, let us say, 50, 60 years, basic textbooks, Public Finance by Richard A. Musgrave and Public Finance by Richard A. Musgrave and Peggy B. Musgrave, they will tell you that given the nature of direct taxes and indirect taxes are more regressive. Direct taxes are considered to be more progressive because as you earn more, you can be asked, you can be taxed more. But in India, we have a very peculiar situation. If you look at income tax, for example, the direct tax, which is the most important direct tax in the country. So what you find here is only about 6% of the Indian population pays income tax. So, and another aspect is, well, if you compare it to the other countries, for example, in India, because of this colonization, we have a tendency to compare everything to UK, Great Britain. If you compare India's percentage of India's population who pays direct taxes. So it's 6% in India compared to 98 or possibly 99% in the UK. So when you have such a small tax base in number of taxpayers, the government of India has been going all out to broad base its tax base. So obviously you have to rely on indirect taxes also to meet the needs of a large and growing economy. So the government, by and large, there's no doubt that direct taxes is the way to go because they are more progressive. As you could have different slabs, as you go upwards, you can pay more taxes. But then, where only when 6% of the Indian population pays income tax, there is no recourse, but also to rely on indirect taxes, impose goods on services tax on a wide variety of goods and services. Thank you.
Thank you, sir. The following question is by Alan, and it says, Sir, as you know, agriculture contributes 18 to 19% of GDP, but however, employs 50 plus percentage of the workforce. Shouldn't the aim be to increase GDP share of India or bring more agriculture workforce to manufacturing sector and service sector?
Yes, I agree with you entirely. In fact, this is what I also said, that agriculture accounts for only 19-20% of GDP. Still about 50% of the 55% of people are engaged, employed or underemployed in agriculture. So this has been a part of a historical process across 5-year plans, across different governments, across finance ministers, across prime ministers to shift a larger proportion of persons working in agriculture to the more productive sectors like industry and services. This is why we have Make Up India, Startup India, so many other programs, shifting the share of manufacturing to 25%. So all these things have been in, this is something like a work in progress. The policymakers are aware of the need to shift a large number and proportion of the workforce employed in agriculture to the more productive sectors like India, but to some extent, only to a little extent, given the magnitude of the problem, we have been successful. Earlier, about 65-70% of people used to be engaged in agriculture. Now, about, let us say, about 56%. So I will not say we have completely failed. We have been partly successful, but certainly there is a lot of catching up to do. We have to do much more and gradually shift more people from agriculture employment to the more productive sectors of industry and services. Even within agriculture, we can do some kind of a course correction. Like, for example, when we say agriculture, for the sake of convenience, we say agriculture, but the full expression is agriculture and allied activities. So this has to be taken as one group. When you look at allied activity, here the productivity is much higher, the revenues, income are much higher. Allied activities cover a wide range of activities such as dairy, fishery, poultry, minor irrigation, farm mechanization, and so on. This budget has some very welcome features on fishery, so which is far more productive than the conventional agriculture. So all these are welcome measures, but this is going to be uh, uh, a long and protracted process. This is a humongous task, and this is not going to happen in a hurry. This will take some time, but I'm happy to share with you that we seem to be on the right track, and going forward, we would achieve greater measure of success in this area. Thank you.
Thank you, sir. We are now getting to the final question due to the time constraint. It's by Hiranshi Garg, and this is what it says. Sir, do you think that government had increased the tax margin from 5 lakhs to 7 lakhs? Is that a good move? And why?
Well, again, it's a complex. One is that it will give benefits to a large number of people who are earning lesser salary, so it would make them tax free. But if you look at the fine print, what you find is one other aspect of this kind of a move is to shift people. Now, for last 2 years, there are two tax regimes which are working simultaneously. One is you can have the new tax regimes in which the threshold level is higher. The other is the conventional tax regime in which you'd be taxed at a lower threshold, but there are exemptions for housing loan, there are exemptions for PF. There are so many variety of exemptions. Now, if you look at the position all over the world, gradually you get, whether you look at Western countries, Germany, France, England, America, anywhere, you get one paycheck and there are no exemptions. So this reduces leakages in the economy, leakages in the tax system. This also reduces the cost of compliance. The government has not. So gradually, the government is trying to incentivize, to give a nudge to the people to move to the new system. Right now, both systems are in vogue. So I think this is a welcome measure. Gradually, all of us have to move in line with the best practices all over the world, that all of us will get one paycheck, and then on that standard paycheck, you will be taxed. So I think it's a good move. Thank you.
Yes, thank you, sir. We are indeed honored to have heard your perceptive words and also definitely an optimistic erudition towards the union budget. Thank you so much once again, sir. Gratitude is the fairest bloom which springs from the soul. I now invite Miss Ashley Wee to propose the word of thanks.
Good evening, one and all present here. I quote, living in a state of gratitude is the gateway to grace. Ariana Huffington. I, on behalf of Department of Economics, Krista Jayanti College, deem it a privilege to propose vote of thanks. The vibration of gratitude attracts more positive thoughts into our life. I take this opportunity to extend our heartfelt gratitude to our most distinguished speaker of the day, Dr. Manoranjan Sharma, for accepting our invitation and spreading the message of knowledge. Thank you, sir. I extend my sincere gratitude to Dr. K. Vinoda Devi, head of the department, for all the solid support and timely monitoring in every aspect as we do. Thank you, ma'am. An expert lecture of this dimension can't happen overnight and needs meticulous planning and execution and an eye for detail. A big thanks to our faculty coordinator, Dr. Raju V. Thank you, sir. I would like to thank our organizing committee and faculties for rendering all possible support towards organizing this lecture. Finally, I would like to thank all of you present here for being with us today and helping us make this event a success. Thank you.
Thank you, Ashley. As this session has come to an end, I request you guys to follow up and give your feedback to the form which is given through the chat box before ending the meeting. You may all now leave.
Thank you, sir.
Thank you, ma'am. Thank you very much.
Yeah. Now host can end the meeting.
Okay, thank you very much. Pleasure being with all of you. Thank you.